All right, so welcome everyone again for your last session of the day. I know you guys are pretty much in and out of sessions, but we're very happy to have all of you guys, very active in the sessions. So right now with our third sessions, we have this mentor session of how to build your financial model 101. So pretty much I've heard a lot of people are very interested in actually joining the session. So we have our mentor here. So we have Miss Shaikha. Tareef is a member of the Association of the Standard Chartered of the Chartered Certified Accountant, ACCA UK, with more than 17 years of experience. So she was appointed as the Chief Financial Officer of Standard Chartered Bank Bahrain (NGCC) in February 2017. She's responsible for planning, implementing, managing, and controlling all financial related activities. So welcome, Shaikha. Thank you for attending.
Welcome, Shaikha.
Thank you, Amira and Badr, for the introduction. And hello, everyone. Good afternoon. I know it's your third session. You're a bit tired. This is what I feared from Badr, but I will try as much as possible to make it an interactive session. It's something very interesting to the session that we're talking about now. Feel free to ask any questions you have. I will try to condense it in 20 to 30 minutes and discuss and present what I have, and then I'll open it for Q&A. Firstly, and as Amira has introduced me, my name is Shaikha Tareef. I'm the CFO for Standard Chartered. I'm responsible for Bahrain and the rest of the GCC countries, excluding UAE. And before that, I was working at KPMG for 10 years. 2 years I've been working in the UK as well in financial services. And the interesting part that when I was working at KPMG as well, I was dealing with a lot of SMEs and small businesses. So there is a lot that I can share with you if you need any help or any questions that you would like us to go through. So the session today is about how to build your finance model. And before going into details about how to build a finance model and what is a finance model, I would like to discuss or share with you, some of you might have their startups, so they actually would understand what I'm trying to talk about, is the key challenges of startups. And why I'm starting with the challenges is because through the finance models, you will try to minimize those challenges and cope with those challenges. And that's the main idea of having a financial model way ahead of starting up your business. So in my opinion, and I have as well a small SME business, so as well from my practice, there are three main laws or challenges when you have a startup. The first law is everything takes longer than you think it will. The second law says everything costs more than you think it will. And the third law is no entrepreneur thinks of everything. We are human beings at the end of the day, so we can't think of everything and anything. Last year, who would have anticipated that COVID-19 would hit us and a pandemic would be in the whole world, and we will be having such problems and issues that we need to deal with. The same thing applies to costs and as well the timelines. Sometimes things do take more than what we expect them to usually take. So, and since you have registered for this, I would like first to introduce you and explain to you what is a financial model. So I spoke to a lot of people beforehand, and I was trying to understand from them when we talk about financial modeling, what do they understand from financial modeling? So different people will have different aspects when they look into financial modeling. One would say it's an Excel sheet that you would have forecasts in it. Some of them would say it's a business financial plan. Others say it will be forecasts or budgeting of your business. And actually, a financial model is a combination of all what I have heard and I've mentioned. It's really what it means to you. It starts with a simple Excel sheet that you would forecast in it your financial performance into future. And then in this model, you will put all your inputs and assumptions, and it will deliver to you the outputs that you expect to share with stakeholders, investors, financiers, and partners, and even any third parties that you would like to show them the progress of your business. So this is in a nutshell what a financial model is and what are the main inputs and what will it produce at the end of the day to you. As part of my experience as well, when I discuss financial models, different people will convey it and will think about it in a different way. Some would say it's a meaningless number and it will never be accurate. Others would say it's only needed for big businesses. I'm a small business startup. Why would I need a complicated business model that I will spend a lot of time trying to figure out and it will never be accurate? Others would say it's a waste of time. And to be very honest, these are all common misperceptions because at the end of the day, there is a reason why we need a financial model. And to be very honest, I've seen people who have worked very closely on their financial models, and I've seen them very proactive. They take actions before others in the markets do take them. They understand the consequences of any decision, and therefore it is very important to lay it out correctly because it's whatever inputs you have that will give you the decision at the end. So do it, but do it correctly, do it properly. Don't do it just for the sake of doing a financial plan, but put your heart in it. And that's the most important advice I would advise you and I would ask you to do. So what are the reasons and why do we need to have a financial model for a startup? I'll summarize it in three main reasons to have a financial model. One is that you need an economically viable business. Today, I'm an investor and you come and explain for me that this is my business plan. I want to do this. I want to do that. I want to transform the way we are dealing with payments or with things, physically. I want to transform it in a digital way. And the idea looks very sound and good and great. But there is something lacking here. Let us quantify and validate what you're trying to say. It's a good plan, but let us quantify it in numbers. What does this business plan means in numbers? Is it sustainable? Is it operating? Will it grow? Are there scenarios that you're talking about? What are the segments you're targeting? So it's very important that you convince yourself and the investor why and how will you be economically viable in the future. There are a lot of businesses, we've been in Bahrain, even worldwide, people started businesses that they like and love, but because they were not economically viable, they had unfortunately to shut it down. So here we're not charity, we're not for profit, we need to combine both and ensure that whatever we are starting really translates in a monetary term and we understand what really is our output at the end of the day. So that's the first reason. The second reason is for fundraising processes. And we've been talking about financiers, and financiers are very important. Today, most of the women fintech initiative that we've been talking about, there is a pitch and you will go and be selected, not only based on ideas, you will need an amount that you will be receiving, and therefore you will need to convince the judges that whatever you are pitching for and whatever that you want to gain is an idea that is financially sound. And therefore, always proof your numbers. Ensure that you are engaged and you understand what is behind your numbers. That is very important. The third reason, and for me that's the most important reason for having a financial plan, is to inform yourself about what you want to achieve before informing the investor or before informing your stakeholders. You will need to understand what you're trying to achieve. You will be spending a lot of hours and time developing this business and working on it day or night. What are your targets? What are your financial targets that you're achieving? Are you doing it not for profit, just to get something into, a business-oriented manner, or you're doing it because you want some targets, and therefore you need to be very clear and specific in your targets. And then once you start in a BAU mode and start working and achieving your performance year on year, you need to measure yourself against those targets and benchmarks that you have set yourself against, and start questioning what is correct and what is wrong. And this is the third and most important reason for having a financial model. So we defined a financial model. We said why we need a financial model. Now, and we said a financial model is an Excel that has inputs and outputs. So in terms of inputs, okay, for any startup, what are the main inputs that you would need in a financial model? Now, if you will go and Google this or ask anyone, they might give you 20 answers, if not more. There are a lot of elements that you would put into a sheet in order to develop a business model or a finance model. The way I look into it, there are 4 elements for any finance model. One is your revenues. The second is your operating expenses, what we call OPEX. The third is your capital expenses. And the fourth is financing. These are the 4 elements for any finance model. Now, when we look into revenues or what we call sales, turnover, earnings, these are all the same, the terminology and the same output at the end of the day. So revenue is the most fun part of the full financial model because this is what you start with. And behind the revenues, there are a lot of assumptions. What is your segment that you're targeting? What is your churn rates? What is your fees or your commission that you're charging your customers? What is your growth rate year on year? What is your, in terms of expansions, if you have any expansions that you are planning in terms of segments, geographies, how is it built into this revenue number? So all of these assumptions will need to tighten up your revenue number, and you would need to come up with a number that you can explain and tell me why would have you anticipated a 1,000 dinars revenues for a startup in the first year. And this is very important. And we will talk later about assumptions and how we do our assumptions and what should we use when we work on assumptions. So this is for revenues and the idea about how to work on revenues as a main input in your financial plan. The second is operating expenses. Now, operating expenses is a very common terminology that we use. And in fintech, you would have a lot of research and development expenses, general expenses, marketing, patent costs, promotional material costs, traveling, online marketing, payroll if you have any staff. All of this is part of your operating expenses. Now, one of my advices to you when you work on your operational expenses, try to detail it as much as possible and try to talk to people who are in business, not necessarily similar to the business that you are doing. It could be in a different industry that you can interrelate to, and try to discuss with them the expenses and what expenses they incur. And it really depends again on the geographies, yeah? So for example, we were talking about VAT, and VAT will increase. And today, if you have a 5% VAT, we've seen Saudi raising it to 15%. Is it something that we're expecting in GCC? So you will need to build up such assumptions and what I call the top-up marginal cost, incremental cost. So you would need to have this on year basis. For example, I work in a bank, I've worked in several enterprises. Usually for cost, we have to build a 3 to 5% increase year on year, what we call the inflationary rate, correct? So we have inflation around us, and therefore what costs us today 10, tomorrow might cost us 11 or 10.5. And therefore you need to be very particular on this and ensure that you've covered this. The second point is your miscellaneous expenses. Ensure that you put and add a line for miscellaneous, and miscellaneous is basically the cost that you have not anticipated initially and might come up as you start working and as you start in your business. This is the second.
Sorry, Shaikha, there's someone who asked, can you repeat the components of revenue that you mentioned earlier?
We will talk about it later, but the main components, and it's not components, it's assumptions. So when you look into the assumptions, there will be a lot of assumptions driving your revenue, like your customers, number of customers, churn rates, the rates that you will be offering, and the rates. Number three is your, for example, geographical or segment that you will be targeting, and how will this impact your revenue. Growth rates. Today, if you have a revenue of 1,000 dinars in the first year, you expect this revenue to increase year on year, given that you will be very well known, your material or your service that you're providing will be marketed for. People will start they will like your product or your service, and they will come back to you, and this is what we call the growth rate. So you will need to ensure that all of these components are captured within your revenue, and the number that you are delivering at the end of the day as a forecasted number embeds all of these assumptions. Now, the assumptions are non-endless. So today you can, and it really depends on the service or what you are providing. So for example, in some instances, I've been talking to people and they have been overestimating revenues because they've done it a year back, and then they thought that whatever they were providing is something unique. And then competition comes in place, in Bahrain and many places in the world, people do like to replicate what other people's are doing. If we find sometimes a successful business, other people would like to have something similar, and therefore you need as well to put competition into your consideration, especially if you are talking about a new idea that is not in the market, and you would anticipate that as this idea and this business becomes successful, people will start copying what you're doing, and therefore this is something which you will need to as well assume in your module. So all of these components, we'll talk later about assumptions, but I would like to cover assumptions in a high level way so that whenever you put any assumptions, you understand exactly what are you putting and why are you putting it. So this is on revenue. On OpEx, we've explained what is OpEx and what we need to do. Capital expenditures is very important, especially when I talk about fintech and the business that we are working and doing, because capital expenses is your computers, your softwares, if there are any patents cost, anything that can be capitalized over 5 years. So if I give you an example, if you go and buy a software today that for any of your fintech or any other related, we in the banks buy softwares that costs us millions of dinars, yeah? So if I buy a software that costs me 5,000 dinars, although I pay the cash in year one, but I will depreciate it over 5 years in my income statement. And therefore, my expense on an annual basis, if I assume that my useful life is 5 years on the software, then my amortization, or because it's a software, we call it amortization on an annual basis is around 1,000. So 1,000 over 5 years gives me the 5,000 total that I have spent on the software. So many startups are incentivized to categorize their expenses as capital expenditures. And it is an advantage that the finance and the accounting principles do give you this. You don't need to have the full cost in your P&L from day one. You can amortize it over 5 or 10 years, depending on the useful life of the software or hardware that you have bought. And you can benefit the advantage of not having a OP loss or a operating loss from day one. This is the third component or element in your financial model input. The fourth component, and it is very important and tricky, it's the financing component. The financing component is basically how will you fund your business? Today, you come with a business plan and a module, which sounds very good. How will you finance it? Will you finance it from your savings, subsidies, loans, investors, equity? There are a lot of ways of funding a startup. You need to know how will you fund it, because loans will have interest expenses. So it will cost you in your P&L, in your income statement. So that's an additional cost. If you are doing it from your savings, it might not cost you now, but then whatever you will be losing, it will be part of your additional loss, personal expenses. And therefore you need to be very careful in what you're investing and not to put all your cash in your business, and only partially, so that you can track the business year on year, see how it is performing, and then work on, you know, the other components. If it's an equity or investors or a subsidy, then it will as well have its own measure. So, and this is very important because it can have additional costs that you will need to account for. And there will be a lot of as well commitments, because if you have a loan, you have a commitment at a particular date every month to pay it. And therefore you need to ensure that you have cash flows to cover such financing financing need that you have basically asked for. So these four components are the main components that you would like to have in any financing model. In OpEx, I would like to mention something very important. If you are either a team or even one-man business, okay, you would need to ensure that you have a salary line, and that salary is your salary, the one-man business salary. What I've seen in many organizations, that the director or whoever is the owner won't have a salary, and this is wrong, because at the end of the day, you want the OP to be reflective of what you have. And if it's not your only job and you're doing something else, but with time, you would need someone basically to do part of what you're doing. So you will need to ensure that your financial model covers salaries, or a one-man salary, and then you can look into if you need 2 or 3 people, but that's very important. I just for your information, I remember at a point of time I was auditing one institution, and the institution was there for around 5 years, and I've not seen a salary line. And I was questioning the person, and he was like full-time working on this business, and I was telling him, yani, how do you spend? This is what you do every day. I've not seen a salary line. He's saying, no, whatever is left at the end of the month, I usually take it and spend it, and this is my income. And I told him, fine, correct, this is your income, but you need to put it as a salary, because at the end of the day, it's not in your bank account. And my advice is always separate your personal bank account and your business bank account. Don't jumble them, don't combine them. It is very difficult. You won't be able to have any audit trail, and it will be very confusing later for you or for the auditor. And if you want to ask for any financing, it will be very difficult to obtain them if you don't have an audit trail. So ensure that these things are all built into your financing model: salaries, and financing, capital expenditures, and all the other stuff which we have been talking about. So these are the 4 elements. Now, we've spoken a lot about assumptions. What are assumptions? How do we do our assumptions? From where we get those assumptions. So today someone is opening a business that is unique. It's not in the market. They will come and say, you know, I have this business, it's not in the market. I want to do a financial module, but I don't have any inputs. There is no information in the market. What should I do? So number 1, and it's the ideal way of doing it, and there's no historical data as well, given that it's the first year, is a research. So by research, you will need to use the past performance of other companies as data points. Now, the companies can be within your geographical location, outside your geographical location, an industry that is similar to your industry. So for example, if somebody is looking into digital payments, for example, you might look into worldwide. There are a lot of researches and surveys on digital payments and how much millions or billions the digital payments can output is, or revenue is. You can use that as a data point and then drill it down until you come to the revenue that you will be generating. It is quite complicated, and it really depends on how complicated is your module and how do you want to do it. And it could be an easy way of discussing with other people who are in the same industry, or doing a survey, targeting people and asking them several questions about what they think it is. If you have such a platform or such application, would you register for it? And what do you think would be more interesting? You know, with surveys, usually you can capture a lot of answers where you can start building into your as part of the research, and you can start building into your assumptions when you start your financial model. And always use a benchmark for your assumptions, because assumptions can be very optimistic, and usually when you are starting up a business, you are usually very optimistic, because if you were not very interested and behind that idea and you want to do it, you will not do it. And because people usually are very excited, they would like to be optimistic in all their estimates, but you will need to be as well with I won't tell you that you have to be optimistic, but you have to be realistic as well. And therefore, I will always recommend that somebody reviews your assumptions, and someone independent, accountant, CFO, someone you trust and understand such things, let them review and see if whatever you have input as assumptions, especially in revenues, are accurate and does it make sense or no. So this is the first way of forecasting our assumptions, which is through research. The second is make range estimates. So there are people who, I've seen their financial models. My revenue is 10. Next year it's 20,000. The year after it's 30,000, 40,000. And I keep on saying these are hard code numbers that does not make any sense. You will need to ensure that whatever you are estimating, number one, it's not a point. It should be a range. You should give me scenarios. Today, you're anticipating the growth rate in your revenue between 2 to 5%. Put the 2 and put the 5. Put the best and put the worst. And you need to understand, because why are you putting the scenarios? Because you need to understand the interrelation between your inputs and the outputs. Today, maybe a growth rate might not have as much weight on your finance model as a salary would have. Maybe a salary of one person would have more influence in your financial model, because maybe the business that you are into needs people who are very skilled and very expensive, and therefore you will need to ensure that whatever you are putting, you have a range for it. Otherwise, it will just be numbers without any proofs and without any, there is nothing behind the numbers. So put a range for growth rates, put range for customer numbers, put a range. I'm expecting customers to be 20, 50, between 50 to 80, 50 to 100. There is no harm of doing such scenarios. The third assumption or advice when you work on your forecast assumptions is use assumptions as variables. At the end of the day, those are assumptions. So don't use them as a hard code figure, okay? So when you talk about, for example, inflation, put inflation 3%, but as well put 5%. So it is very important to have such ranges and such variables within your financial plan. I know there are a couple of questions. I'll finish the assumptions and then I'll go to the questions and then come back to. The fourth important thing is label the assumptions clearly. So usually when you prepare assumptions on an Excel or financial module on an Excel, you would need to label the assumptions very clearly. Use descriptive labels so you can understand what the assumptions mean, add notes. And my advice is always, when you work on your plan, consider that you are not preparing it only for yourself. You are preparing it for someone who does not understand your business and will have a read through it and can understand the numbers and assumptions. And believe me, if you prepare a business or a financial plan or model, and you will leave it for 1 year or 6 months and come later to it, you will forget all the assumptions. So that's why it needs to be clearly labeled and articulated, each and every assumption. The fifth advice when you work on your assumptions is show your working and your calculations. Say that my fees, and do the formula. The fees assumed is 1 dinar multiplied by the number of transactions, by the number of customers, by the monthly fees, the period. It needs to be so much detail that anyone can reference to it and can understand what really is under those assumptions. So we have a couple of questions.
Yeah. So I think one of the questions we have is from an anonymous attendee. when should we start creating a financial model? In which process of the startup?
Before you start the business, the minute you think that you start thinking that I want to create and I want to be in business before even pitching for anything, you need to create a business model. So, for example, I've met someone who wanted to open an organization, a small business. It was quite unique in nature, and we don't have it in Bahrain. So he approached me and he said, "Sheikha, I have this. I will need to work on a financial model." And I said for him, and it was a simple concept where it was like service related. So I said for him, it's not very complicated. You would need to understand your customers and start working on it before even thinking about the business and start working on it. So we need to understand the rent, for example, employees, and then work on it. Because it is a decision for you to open a startup. You will need first to decide on this, then decide if I really want a business or not. Because you might do a plan and it shows that you don't have customers here in Bahrain or in that geographical location. And therefore, I don't need to have a business here. So you will need to do that before even pitching or even before thinking seriously about, starting a business. So I would recommend it as an initial step. The same way you do a business plan, you put the idea in the same business plan, a financial model needs to be developed. And it will give you better understanding of the business you are into, because sometimes we like things, we love them, and we think if we do them, we will be very successful. But when we start talking more to people who are either in the same business and understand the challenges, and you might start thinking differently. Maybe I have to do it, but in a different way. Maybe I have to do it, but I need to target different segments. Maybe I need to put it in a different location. Maybe I need to do it and attract GCC, for example. So now with the online applications and COVID, suddenly you've seen institutions in Bahrain reaching to people in GCC and Middle East. Earlier, their customers were only Bahrainis coming out from schools or, in particular places. So this is where you start thinking and changing. So it's not even a static plan. It's something that changes, and it's a live document as well.
So the second question we have is from Hara Faisal. So you mentioned in the business model that there are 4 points, which are revenue, operating expenses, financing, and she kind of missed the last one.
CapEx. CapEx is capital expenses. So capital expenses is all your hardware and software. So for example, if you buy a computer, a software, patents, it could be as well. It depends really on the business, but in some businesses where you have factories, you would have machineries as well. So it's something which you would utilize over 5 to 10 years, for example, or 20 years. So it's the useful life. So for example, if you're talking about fintech, you might be investing in softwares or programs. Now those softwares will not be expensed all in the P&L in year one as you pay them, and you can amortize them or depreciate them. In this case, it's amortized over 5 to 10 years, which will lower or will reduce the burden on your operating profit at the end of the day. So imagine if you buy something costing 5,000, instead of putting 5,000 in year one, it will be 1,000 every year over the next 5 years. So this is it. It's called capital expense.
So we have another question from Jane Houghton. So do all companies have to pay VAT regardless of annual income, or do all companies have to be audited annually?
Okay, so the questions for both is no, not all companies. VAT has a threshold. It's around $100,000, I think, per annum on a revenue basis. So to answer your question, no, not all companies. Small companies, depending on their revenues, will not need it. At a point of time, I think it will be optional for everyone to enroll for it. And it really depends on the business. So I've seen it a lot in businesses where they have machineries or some equipments, a lot of supplies that they were registered because they will need to get the input VAT back to it. So I won't go into details about that, but to answer your first question, no, it depends on the annual income. And your second question, do all companies have to be audited annually? Again, no. There is no law that asks you to either audit your annual financials. But my recommendation is have someone on a weekly, monthly basis that manages your bookkeeping. It is very important. I've been auditing a lot of organizations, especially when the Tamkeen project started. we were engaged with a lot of small and medium enterprises that, because the Tamkeen package initially, maybe 10 years back or 7 years back, was almost like giving packages for 500 dinars. You can do audit and bookkeeping. So a lot of companies have approached Big Fours in order to help them with this. And I've seen medium-sized companies that were not having a proper bookkeeping, and their bank statements, as I said, personal and corporate bank statements were all, as a one pocket, which made it very difficult. And we had to qualify some of our opinions in the audits. And the minute you qualify an audit opinion, then if you're doing this audit for a loan or for a third party where you will need to get an investor financing, this might as well not be seen the way you want usually to get through that module and get it and get the loan out of the bank or the Tamkeen or whatever. So I would recommend that you would have a proper finance bookkeeping, and that's very important. Audit that can come later.
Yeah, I think one of the attendees as well, Hadarati, she said that it is preferable to have at least a management account for credibility. Agree.
I think it is very important. Bookkeeping is very important. There is a lot of those, I would say, the part-time bookkeepers that can come once in a month. They're not costly, but usually people who start business, most of them might not be very much finance oriented, and they want to have a successful setup of business. And they will focus a lot on setting up their business in the accurate way, quality control in terms of what they are providing, and they will miss few things. Now, to have someone who is managing your books might cost you peanuts at the end of the day, but because people might not view it very important, they might ignore it at a point of time, and then later they might start doing it, which will have a lot of issues later. So my suggestion is don't postpone it. Start having someone maintaining your books from day one if you are not capable of doing so.
So we also have a question from anonymous attendee. So how can we research and obtain accurate assumptions for our financial model when we haven't established the business yet?
So again, by research, what do we mean by research? Now, here research is a very broad term. So we said you can research through checking financials of similar businesses. Okay, now it depends again about the business we're talking about. Some businesses will have historical financial information available, either on the websites, on their website, some information. And in many cases, if it's not ready available, and especially medium-sized or bigger organizations, they might not put all their financials. I'm sure there will be some information that you can use and start building up your assumptions from there. Number two is talking to people as well, especially people from the same industry or people that deal with them. Number three is surveys and questionnaires before opening even your business, maybe with people or with through Instagram accounts, or social media nowadays is very active. And the minute you ask any question about would you like to apply for this, would you like to do this, the ratings, there have been a lot of ways of getting people direct opinion on things before it starts. Of course, historical information, financial information is the most reliable if it's available. But if it's not available, then you would need to start, searching further into either inputs from those organizations or talking to people or doing surveys by yourself.
Sorry. We have a question from Mohammed Ahmed as well. So highlight on how to prepare projected statements in startups.
So this is what we've been talking about, Mohammed. So how to prepare projected statements in startups. This is what the 4 elements I've been talking about. Now, how to prepare it in details is a session by itself, and it will really depend and vary from one business to another. So I might prepare it for a fintech kind of a startup, which could be different than if I do it for another business. So what I'm suggesting, and this is very important, there are 2 ways of looking into it. If you Google, there will be tons of Excel sheets that will explain to you in details how to prepare a projected statement in an Excel. It will give you the revenue, it will give you the cost of sales if you're in that business, it will give you the expenses and all other aspects. And for me, that's not difficult because it's something which is well known and written. The issue is, again, about the assumptions behind those inputs. The numbers and the inputs that we need to put there is quite identifiable and very easy. My advice as well, the second advice is people might not be comfortable with ready-made Excel sheets when they work on their finance model. So if you have anyone or if you yourself can work and create from scratch based on what you've seen a finance model, that will be much more better because you will understand it end to end. You will cover everything end to end in it. You will not say, I've relied on this. So look into a couple of online Excels and then based on that, start building your own finance model if you would like. So otherwise, I think the online, before coming to this session, I was just looking into the online Excels that have been prepared for finance models. It's a lot, and all of them are very good, to be very honest. And there are very reputable kind of organizations and systems and applications that you can get from them. This along with the assistance on it if it is required.
So I think that's it for now for all of our questions. So if there's anything else as well you'd like to touch on everything.
Good. So I'll just go through the, we were talking about the forecast assumptions and to summarize the forecast assumptions, and I think these are the main inputs as we have mentioned. I would like to leave you with forecasts on 4 important things. One is look ahead rather than simply at the past. If you have a past now, if you're a startup, you won't have a past, so it's good. It is a continuous process. So financial models, you don't build them, leave them aside, come to them after a year. It is something that you will continuously look at, adjust, check, change, correct if required. Not all your assumptions will be accurate. There will be wrong assumptions that you will need to correct. 3, let it be very clear and easily compared to your accounts. I've seen budgets and forecasts where people put forecasts and then when we compare them to their accounts once they go live, it's not comparable. It's here he's talking about OPEX and here he's talking about something else. So it needs to be comparable, the same language we're talking. And number 4 is give details of assumptions. It is very important to give details of assumptions.
So I think there is actually one more question. That's Sol Al-Fardan was asking, what is the best institution or company in Bahrain that provides feasibility studies for business ideas?
I usually will not recommend any names here. There are a lot. Feasibility actually depends on your budget, to be very honest. There are organizations that are very expensive. There are organizations which are less worthy. But look, to be very honest, I've worked as an auditor for a couple of years now. And I think it's 2 things, because due diligence and those analyses are done by companies, but the driver is you. You will understand it more than anyone else. And at the end of the day, this due diligence happens and they get inputs from the owner or the management team at the end of the day. So you try as much as possible, especially in a startup, to understand your business and not try to outsource it to a third, to a company to do this on your behalf.
Yeah, can I just jump in for 1 second about that question? And I think that's a great answer. And I think, especially early on, you want to be careful about what your kind of expenses are and so on. But you need to keep in mind that online, there's a lot of really, really powerful tools that are available, which I think you can use. I'll send you some links of one of them, which is actually particularly good, called Live Plan, which is basically what it allows you to do is to build a very, fundamental, basic business model. But then what it does is that it compares it against best practice on different businesses that are in the same kind of field that you're in. So then it can tell you that, okay, so typically businesses within your kind of area have XYZ kind of expenses. Maybe you should be considering these as some items that you should be adding onto your business plan and so on. So I'll share with that, and I'll share you the link with that, and you can take a look at it on your own time.
And
Yeah.
use a tool as an assistance, not as an indication of what you have to do. And this is always my advice, because at the end of the day, that's a tool that is fed information. So you are the person who have logic, and you will always need to analyze this. You will always be able to compare it with your geography, with the place you want to have that startup in, segment you're approaching. So use that tool that Badr will be sending as an assistant only. This is my only advice at this stage when it comes to tools. So we spoke about financial modeling, and there are two approaches usually for financial modeling, or ways of doing finance modeling. One is what we call the top-down forecasting and the bottom-up forecasting. Now, at this part of the world, we're very used to the bottom-up forecasting. The bottom-up forecasting is what we have been talking about, is you go in details, look into the assumptions, and based on the assumptions, start to drive your revenues, expenses, OP and other aspects. And that is what we do. And to be very honest, this is a very good tool, especially if you want to forecast for 1 or 2 years, and you're in a startup phase where you would need to have the detailed inputs to deliver your financial module. But the other tool that we is as well used widely is something called the top-down forecasting. Now, the top-down forecasting will need a lot of information. And going back to the research piece, it might be available, it might not be available. So just to explain to you what's the top-down approach. So the top-down forecasting is a method of estimating a company's future performance by starting with a high-level market data. And then you work it down to the revenue, okay? So let me give you an example. So today, for example, we talk about, for example, online payments. So you go and say online payments worldwide, and you will find the number is around, say, $5 trillion per annum. So this is the online payment worldwide. Then you take it to the second level and say, okay, I'm trying to do online payments for this geography and for this industry and for this segment. Identify the 3 categories about what are you targeting exactly, and then the 5 or 10 trillion or billion that you have been looking into as your total available market, you'll take it down to what you have, which is your serviceable target. Then from there, you will break it down to your revenue. How much percentage of the service available market will be your objective or your target in country. I've not seen this done, I've not seen this being used a lot in this part of the world for several reasons. One is the figures are not easily found in Google, or it's not very transparent, or you can find the figures. Number 2, for example, in fintech, it's a new terminology coming up, and therefore you will not find a lot of competitors and a lot of information as well that you can rely on. And therefore I've not seen it. But if it is available, it's a good approach to use. Now, the only problem with this approach, you can end up having a very huge number, because you're starting with worldwide numbers and then taking percentages of it until you come down to the number, to the revenue number. Number 2, it's a bit complicated maybe for people who would like something more simplified and realistic. So again, it depends on your module. It depends on what you believe is better to use and what you think will make more sense for you. But these 2 methodologies are the 2 main approaches, common approaches that are used in business generally. And I would usually recommend for short-term forecasts to use the bottom-up forecasting, and for the longer terms to use the top-down forecasting. Like for example, in banks and financial institutions, it can be used easily, but in startups, you know, it might be something which you would need to spend a lot of time and efforts to get the information.
Yes, so we have one question from Fauzia. So she mentioned, you mentioned we need to add miscellaneous expenses to the OPEX budget line. However, should we also factor in any costs associated with unforeseen risk as part of contingency planning? If so, what would be a realistic percentage?
Okay, so usually when I talk about miscellaneous, it's all what we have not factored for. Yeah, because as I said, you try as much as possible to detail your expenses. And from the challenges we've started with, no matter how much you try to put everything together, you will be missing something. Nothing will be like real life. Yeah, real life is the realistic number at the end of the day. But yes, with the miscellaneous, there will be the risk factor there. So for example, some unknown, so we've spoken about VAT, for example. So VAT is something unknown to us. So for example, today, if I am providing a service and my revenue is greater than the VAT threshold registrants, and I would need to register for VAT, the minute the VAT increases from 5 to 10, for example, then I would need to factor for an additional 5% that will be either charged to the customer and will be paid, or even in my expenses, because my expenses it will as well be. So you will need to look into all of this when usually you put into miscellaneous. Now the percentage, usually when we look into percentages, it will not be more than 5 to 7%. From your total cost. So it needs to be something which is in line with a bit higher than the inflation rate. So the inflation rate is 3% usually that we use for Bahrain. So it will be some incremental amount. So usually as part of the practice, 5 to 7% is what we use.
All right, I think that's pretty much for the question. Oh, actually, we have one that just came in. So how could we price the product or the service?
Now, it really depends on the product and the service, and I can't tell you how to price it because it depends on the product that we are talking about. Now, one of the ways of pricing it is to look into competition and how competition is pricing it, and what are you doing different if you want to add any incremental pricing into this, what are you providing differently? So I've seen, so let us talk about an example of institutions, yeah? So I have 3 kids, mashallah. So when I take them to any institution to either learn a sport or anything else, okay, there will be a lot of variations. There will be cheap ones, there will be expensive ones, there will be things in between. At the end of the day, I will look into the service. So I will look into what is more reputable, where my son or my daughter really can grasp things within a particular period. Are they benefiting? Do they like it? So, and this is where sometimes you find products, but it's the tool. So when you look into banks, and I work in a bank, okay, why would you like to go to bank X and not bank Y? It could be the online application. The online application is very easy. You can just strive and do whatever you want to do. You don't need to contact people. If you have any problem, you can raise it over the online banking. They will solve it to you. And you might be willing to pay annual fees on their credit cards or anything because they are providing you the service you are willing to, you like, and you would like to continue with them. While if you go to any other institution, it could be much more cheaper. You might be getting few benefits, but you don't like the service they are providing. And this is what makes the big difference, even when you look into the pricing and how would you price your products. So one of it is the service you're providing. Is it something unique? Are you the only person giving this service? Is there anyone competing? And if anyone is competing, then what is the competition based on? You need to differentiate yourself. I think these are the main factors for putting a price on your product. Otherwise, if you put an overstated price, it will just stay stale, you won't have customers, and by time you will start reducing your prices or working on a different strategy to change your business model. Okay, so the last part is the outcomes of the financial model. So we've spoken about inputs and about assumptions. So what are the outcomes? I've worked on the financial model, I've worked on the Excel, I've kept all the inputs. Now, what I'm expecting at the end of the day. So these are the three statements we all know about. It is the income statement, which is the P&L, balance sheet, and your cash flows. Now, I'm not very sure if everyone, I've seen from the questions, there are people who are into business, they know their stuff, and actually they're advising as well. People, thank you very much for the advices. It would be very helpful to post any advices to as well people who are starting up their business. So the financial statements, if I look into it, these three main statements are the most important statements for any startup. So there are a lot of schedules as part of accounting. And as a startup, I don't want you to go into details of this. If you get those three statements in place and I won't say accurate, but budgeted for and forecasted, then your outputs are delivered. The first is the profit and loss, and this is what gives you your operating profit or operating loss at the end of the day. It's, if you remember the four elements we spoke about, the revenues, OPEX, CAPEX, and financing, three elements, revenues, OPEX, and CAPEX, part of the CAPEX is all in your P&L, it's in your income statement. It will give you the value of your what you have generated as part of your income minus your expenses and what you have achieved at the end of the period. And it's usually for a period. So if you start 1st of January till end of December 2020, it will cover the 12 months. It can be for 6 months, 3 months. It will give you your overall performance over the period that you have prepared the financials for. The second one is the balance sheet. Now, balance sheet sometimes is not considered to be one of the most important statements, and it really depends on the business you are doing. But I still consider it to be very important. A balance sheet has assets and liabilities. Assets is what you own, what your business owns. So if we're talking about fintech, you might own a software, you might own a hardware, you might own a patent, you might own an inventory. So all of these are very important because it basically captures the value of your institution. Usually when anyone buys an institution, of course there will be goodwill and other stuff, but this is the part of the value of your institution. What do you own in this institution? The second part of it is the liabilities. Liabilities is how are you financing this institution? Are you financing it by liabilities? Are you lending? Do you have loans from the banks and this is the way you're financing it? Are you financing it through injecting capital from your own personal account? Are you financing it through subsidies from the government or Tamkeen? So it will give the investor or the financer or even yourself an overall picture of what you own and what you owe. And that's very important. The third statement is the cash flow. Now, I'm an accountant, but I have to say this, cash flow is the real statement out of the three. Why? Because P&L and balance sheet are based on assumptions. So when I told you, you take your asset, you divide it by 5, your useful life, and 1,000 dinars every year. I can come and say your useful life is 5 years. Someone else can say the software useful life is 7 years. Your profit and loss will change on an annual basis. There will be some assumptions as well in accounting policies in terms of revenue recognition, in terms of P&L, if you're in a sophisticated business, recoveries and provisions. And so what I'm trying to say that profit and loss and balance sheet could be to some extent judgmental because it's assumptions based. Cash flow is the cash in the bank. It's what you have in your bank account. It will never be wrong. Now, we need to be very careful about this point because sometimes institutions, and especially small and medium, can go into bankruptcy and into problems because of mismanagement of cash flows. I've seen people or organizations where they go into debt and they have issues with their maturity buckets, i.e. they cannot fund the due dates of their liabilities, and which takes them into a lot of problems in terms of bankruptcy. You need to ensure that there is a matching principle, that whatever you are receiving as part of your revenues or OP, you can finance in it your liability, or not only your liabilities, but your commitments, because you will have as well salaries to pay, you will have other expenses to pay. These are all commitments and liabilities. So you would need to ensure that you have a healthy cash flow. Use maturity bucketing. Maturity bucketing, we usually, and banks use it for liquidity purposes. So today I would say I have a $10 million, my $10 million that I lend it to my customers. I'll give personal loans, auto loans of 8 million. I'll have 2 million in cash that I can invest as a residual balance, and this will give me some income. The same thing applies to small organizations. You need to ensure that when you pay salaries on a monthly basis, you have income and you have cash to cover those expenses on a monthly basis. Otherwise, you're just preparing yourself for a trouble to come very soon. Most of the institutions that goes into issues, it's not that they don't have cash. They have cash, but the cash would need 6 months to come because they've given the customer 6 months to repay. And he's committed now and has to pay to someone that he does not have cash. So we need to ensure that this works very well. That's why cash flows focus on them. And initially when I said put your personal and your business banks separate, this is as well one of the important aspects that you would need. Otherwise, you won't be able really to separate your books. And you will end up in a bigger problem if you won't be able to separate your books. And the cash flow always allows management to make informed decisions on business operations as well and investments. So usually cash flows will have like operational cash flows, investing cash flow, and financing cash flows. So you will understand from where all your cash is coming. Is your cash coming from your operations, like your revenue? Is it coming from investments? Maybe you've invested an amount in a treasury bill or in a bond or in a bank, and a percentage of that is coming to you. Is it based on financing? And truly depends on the business and the way you want and the way you are diversifying your cash statement inflows and outflows. And at the end of the day, it will impact your cash positions at the end of the day. So these are the three main outputs that any financial model will deliver. And the most important thing is to always have a what-if scenario. ماذا إذا يعني what if scenario is very important. What about if I didn't start now? What about if my startup was delayed for 6 months? Now, if you have this what if scenarios, and this is when I started saying, best, worst, and a normal scenario, BAU scenario, you will be on the right track because you will understand the circumstances. And it's not wrong to have 1 or 2 scenarios, and then when you start up, you come to know that no, my scenarios are not accurate. I need to fine tune them. I need to change few things in them. That's fine. We as institutions, we've budgeted for our numbers. We usually start budgeting in August or September of the year before. So when we started doing our budgets and forecasts, we did it for 2020, and life was very nice that time in September. Yeah, we expected our economies to grow, everything to flourish. Numbers have been very good and nice. Suddenly, the COVID-19 hit us very hardly. We had to do a budget restatement. Numbers we've been talking about is not anymore realistic. We are not delivering. It's not only us, it's the full world. We need to look into the numbers again and do a restatement in our budgets. So we have to continue looking into those scenarios and into those inputs. And unfortunately, in many cases, life of entrepreneurs tend to be more disappointing in practice. Therefore, next to your default finance plan, always prepare a less optimistic scenario, I would say. So this is it in terms of outputs, what-if scenarios, approaches. I don't know, Amira, if we have any questions before I just end it with a couple of 5-6 notes for everyone to take away with.
So I
takeaways?
think we just have this last two questions that we'll be answering. So just one from Mariam Ali. So we're mostly facing up the unpredictable losses these days in businesses. So the financial risk assumptions that we can't predict. Any suggestion in financial risk assumptions?
Again, now the financial risk, so for example, let me give you this example. So the financial risk assumptions could be a lot. So number one, you want to start up a business today. It gets postponed for 6 months or 1 year. You have taxes, for example, that will be imposed. You have withholding tax that can come up. So at the end of the day, risks are a lot. That's why I'm saying that whenever you put it, don't be bad pessimistic and start building risks that will not make sense. So whenever you're building your financial model, try to have a margin that will cover part of those risks. Yeah, and you need to understand the business you are at. Don't work and don't start in a business that you don't understand the business. And the financial module will give you that kind of understanding, because it will ask you for inputs that you will need to prove that they are correct. Now, do you understand your business? Do you know what is the main components and drivers of the business? Have you done your analysis correctly before starting your business? You know, it could be the traditional ways of doing your analysis. It could be more talking to people, doing researches and trying to think, you know, out of the box as well. But yes, risk factors are there, and we've seen it just increasing. It's not reducing. But if you start embedding a lot of risk factors in your module, the module will not work. So you will need to balance it.
Yes, and I think this one more last question. So it's anonymous. So what kind of main expenses would be incurred considering that our business is purely an online service? Apart from marketing costs being the biggest part in an expense, and that is tech is developed ourselves with a software that we already own.
Okay, so software, I'm sure software, there will be some expenses on the software maintenance or additional expenses. So this is very important in terms of expenses. I'm not very sure if there is any payroll expenses. As you said, marketing, I don't know if there will be any research and development for you to start enhancing the tool, if you will have any finance and accounting, if you will have any legal advisory costs that you will be maintaining, if you will have any I'm just thinking aloud, municipality fees, technological costs, additional, because all of these capital equipment you buy, either computers or hardware, part of it will come through your P&L through depreciation and amortization. So it's not only going to your balance sheet. So this is something as well that you will need to work on. Otherwise, if you're doing your business, you only have software and marketing, then it will be a less I won't say costly business, because it could be very costly, but you will have less lines to worry about compared to a full-fledged business. But you will need to ensure that the software costs are, because software costs usually have additional built-ups into it. If you need to either upgrade them or, you know, get any new kind of applications or work on them. So you need to ensure that all of this is captured in your assumptions.
I think those are very great tips and great suggestions that you've given all of our startups. And I know we do have a lot of more questions, but unfortunately, you know, we've passed the time. But again, Shaikha, thank you very much for giving us your time. I know it's a weekend, so but thank you very much for helping our startups. And I'm sure, you know, whatever suggestion and advices you've provided, they can implement it in their own business ideas. So thank you very much, Shaikha. And thank you very much, everyone, for joining us in this last session. After this last session, you can just continue working on with your team to, you know, and implement all of the learnings of today's session. And, you know, for anyone who has scheduled with Better, you can go on and do so and attend the sessions with them. But again, thank you very much, Shaikha.
Thank you all for attending. I hope it was helpful.
Thank
Thanks.
you. Thank you.